Good evening, ladies and gentlemen, and welcome to this evening's Strategy of the Week, Protect Thy Capital. My name is Kevin Crow, Manager of Retirement Services, and I'll be your host this evening. Today's investors find themselves with more choice in which to save and invest than was available as little as 20 years ago. However, despite the many choices we have, the one constant is that we must invest in companies that are making money for their shareholders, and as a consequence, we'll make money. The challenges of investing are manyfold, but at VectorVest we like to boil it down to three things: when to buy, what to buy, and when to sell. In terms of when to buy, we always have to and constantly assess what the market is telling us, and are conditions conducive to buying stock consistent with VectorVest's timing signals and our own risk tolerance. In terms of what to buy, at VectorVest we research a particular company, we build watch lists, we check the VectorVest RV, RS, RT, and VST. We look at graphs, we run backtests, and we examine earnings. Finally, we decide to invest our hard-earned capital with the hope and expectation that we will make money. And in terms of when to sell, do we have and have we outlined particular targets or strategies that we will use when the time comes to sell? The investment quandary that arises is a basic question. Do we have a defined strategy to manage, one, our profits? When will we take those profits? What percent return? How about our losses? Will we accept only a certain amount of loss before we decide this is a trade that's not working? Or are we going to let those losses run unabated? And finally, we must take into consideration earnings announcements, because earnings do move the market and they do move the stock. So the answer to the question is yes. There is a way to have that defined strategy, and it's called a collar trade. Let's take a look at a definition of a collar trade as defined by Investopedia. A collar trade is a protective option strategy that is implemented after a long position in a stock has experienced substantial gains. It is created by purchasing an out-of-the-money put while we simultaneously write an out-of-the-money call. Now, there are several compelling benefits to having a collar strategy. First of all, we are dealing with a stock-specific protection. Yes, we can use this to protect an entire portfolio, but since companies announce earnings at different times, it perhaps is more relevant to a portfolio to be stock-specific. Secondly, we're dealing with a known event. Companies publish their earnings dates. We know when they are and therefore can prepare the playing field, if you will, for the appropriate strategy. Third, allows us to proactively manage our portfolio versus being reactive. We'd rather have a strategy that we know we're going to implement and is in place versus reacting to the whims and vagaries of the market. And finally, over the past 20 years, the absolute explosion in high-frequency traders who lurch waiting for earnings to be announced, and if the earnings are not to their satisfaction, will dump millions of shares on the market in a matter of moments, and in turn does severe damage to people who may own those stocks. With collar trades, there are three basic strategies, one of which is we can use an out-of-the-money collar, which gives us the least amount of protection, but it gives us more upside growth. We can use the at-the-money, which doesn't provide a lot of growth, but will give us more protection. And the in-the-money will give us the most protection, but little or no growth. Today, we're going to confine ourselves, in a few moments, to the out-of-the-money and the at-the-money strategy. So let's get right into our program. I'm going to come up here to Viewers. I'm going to change our date to July the 8th. Click OK. And I'm going to type in here ISRG for Intuitive Surgical. Now, I chose July the 8th because I knew earnings were announced shortly after July the 8th, approximately the 18th. But the stock had already started a downturn. In fact, let's take a look at its chart. As you can see, on July the 9th, the stock took a tremendous jolt to the downside due to some bad news. So I wanted to use July the 8th as just a setup so that you could see the full impact of what happens when a stock drops as viciously as this one has. Go back to our program. We'll come back to Intuitive Surgical. I'm going to right click, and now we're going to analyze and set up a collar trade. So I'm going to go to Analyze Options, go bearish, and I'm going to use a collar trade. Now initially it's going to give me a setup with July as the expiration month, but since our trade date is in July, July the 8th, I'm going to modify and adjust or edit our strikes and our expirations. So I'm going to go out a month further to August, and since the stock is currently at 500, I'm going to keep this $505 price and click OK. You'll notice it has changed to August. Our strike is 505, and now let's edit our put. Again, I will use an August expiration, and I'm going to make this put at the money. So since our stock is at 508 cents, I'm going to use the 500 strike price. Click OK. Now let's examine a couple things so that you have a good sense of the setup. First, we have both options expiring in the same month. By selling a call against our long position, we brought in option premium. I'll scroll to the right. In fact, we brought in $17.05. Because we chose a $505 strike price, should we be wrong about earnings, I have a little bit of room to the upside to make some money. But I'm doing this largely to finance the purchase of my put, which cost me, or us, $19.70. And one last thing, we want to always check our delta. Our long delta is 0.48, which means for every dollar the price of Intuitive Surgical should drop at this point, the option will go up by 48 cents in value, and that number will move towards -1 as the stock continues to drop, meaning that for every point the stock drops, the option price will go up by $1. So let's take a quick look, because remember the 8th was the day before that very large drop. Now we would not have known that that was coming, so let's see what would have happened. Well, we go forward a day and look at the drop in our stock. We are down $80,708. And I realize this is a lot of money, and many of you may not trade this amount of money, but you can always adjust this money to be proportionate to your own account. This could be 1, it could be 5, it could be 10, it could be 100. But we tend to use 10 as a default, and I wanted to show you that. And again, emphasize, one day later, you're down over $80,000. But wait. First off, we received some money, did we not, for selling the call? Well, that short call is now worth $16,450, but look at the value of our put. It's now worth $62,150. The price of the put option changed in price from $19.70 to $81.85. Well, let's look at what the net result was to us. We're down $2,180. Now, I'm not demeaning that as a small sum of money, but it sure as heck is a lot better than $80,780. Let's do this. I said that the earnings were announced on the 18th, so I'm going to click on our calendar. I'm going to move forward to the 19th because I believe the earnings came out after the market closed. So let's click on the 19th and see if there was any change. Wow. Now our stock has dropped to 107,410, negative $107,410. But that's been offset by the gain in our put option and the money we received from our call option. So the net to us is, despite the stock being down over $107,000, we're in relatively good shape, and we'll be around to play again another day because we're down $3,470. So in a recap, what we've done here is we've used a little bit of at the money and out of the money, in the sense that we used an at the money for our put because I wanted the delta to give me the fastest or the greatest growth in the shortest period of time. And we sold the out of the money call because we wanted a little bit of growth should we be wrong on the direction of the underlying security, in this case Intuitive Surgical. Okay, well, let's come out of this option analyzer. We'll come back to our home page and let's start this process again, except this time I'm going to use a more contemporary date. I'm going to go to viewers. Again, we've got stock viewer. I'm going to clear find, and I'm going to type in SLCA for US Celica. Now, US Celica came out with their earnings on July 31st after the close. So let's change this date And we're going to change this to the day before, and we're going to change this to the 31st. Click OK. So on that date, the price was $24.20. Now, as I mentioned a moment ago, earnings were announced after the close. U.S. Celica missed their earnings by 2%, and the stock dropped 7% in after-hours trading. So while we were home having dinner, if we had no protection on this particular stock and we happened to own it, we're down 7%. Well, let's take a look at how we could have defensed against that. So again, we're going to right-click. We're going to go to Analyze Options. A caller is considered a bearish strategy, and we're going to click on Caller. Now, once again, Option Analyzer sets us up in the most recent month, but we're going to make some adjustments because we want to be far enough out that we allow the options to do their job. So I'm going to right-click on the edit. I'm going to come to the option expiration. I'm changing our expiration to September, because remember, I want to have that option, especially that long put, have it have time to work. And we're going to change our strike price to a 25. Click OK. Double check to make sure we have this correct. We do. Now we'll go to our second edit for our put. We're going to change the strike and the expiration. So we now have a September expiration, and we're also going to use a 25 put. We're getting as close to the money as we can given the current price of the stock. Now we'll go back to our trade date of 7/31 or the day before earnings, and again, let's see what would have happened one day forward. So we move forward one day. The stock is down $1,730. Our options are currently valued at $950, part of that premium we received for selling the call, but our put option has jumped from $2.53 to a current premium of $3.33, or a value of $770. Well, our positives against our negative ends up with a net loss one day into the trade of $10, while the stock in after-hours trading on the 31st dropped 7%. So in fact, what one has to question as part of their overall equity strategy is, first, is profit my primary objective, or should it be mitigating my losses? From the perspective of this speaker, mitigating losses and having a strategy in place so that you protect your capital to continue to be able to play another day is foremost. So let's summarize what we discussed this evening. First of all, as I mentioned right at the conclusion of the presentation, it is absolutely necessary that you protect thy capital. The ability to survive unexpected occurrences in the market is paramount to long-term success. Secondly, this provides us with an opportunity to make money and protect money. Third, by using Option Analyzer, we have a great tool that allows us to not only measure results, but allows us to play what if. What if I change this expiration date? What if I change this strike price? How will that affect the outcome, and is that an outcome I can live with? And finally, at the foremost front of your thinking in terms of your investment strategies, always think defense. It's easier to play another day when the market doesn't go in our direction, but it's harder to make it up when we have substantial losses. I hope you enjoyed this evening's presentation. If you need to reach us, you see both our telephone numbers and our web address, and I wish you a pleasant weekend.